Welcome to your daily deep dive. You know the market has just gone through a massive shakeup, that sudden $19 billion drop in leverage. We called it a deleveraging event. But today's sources show the real story isn't really panic. It feels more like a phase of critical, kind of messy consolidation. Bitcoin has slipped below that $113,000 level again, and well, we need to figure out what's pulling harder, these macro risks or the long-term adoption signals.
That really is the precise tension the sources are outlining today.
Yeah.
We're watching these persistent macroeconomic headwinds, driven largely by escalating geopolitical actions, pulling the price down. But at the same time, you've got these strong, positive, long-term adoption signals actively trying to provide a floor underneath it all.
Right. It's a complex tug of war.
It really is. And our mission today is basically to give you the exact coordinates of that battle.
So we are diving deep into how the market responded to that leverage flush. We'll analyze the technical levels that define this immediate fight and, maybe most importantly, examine why volatility driven by geopolitics is now, well, the new baseline scenario. Okay, let's start with maybe the clearest signal of institutional conviction right now. The flow of capital in and out of the U.S. ETFs.
Yeah, the first settled post-crash data from the U.S. spot Bitcoin ETFs gives us our first real look at the institutional reaction. And look, the initial headline does look a bit concerning. We saw net outflows over $326 million from the spot Bitcoin ETFs alone.
Okay.
And when you factor in Ethereum ETFs as well, the total crypto ETF outflow actually hit $755 million. That's some serious short-term caution.
Yeah, if we just read that headline number, it sounds like institutional confidence is just collapsing. But you highlighted a critical divergence inside that data, right? What story does that tell us about the kind of capital exiting versus the capital still coming in?
Yes, exactly. The headline really masks a clear split between, let's say, tactical and strategic capital. So on the outflow side, you have the more tactical, momentum-sensitive players. Grayscale's GBTC led the withdrawals, $145.4 million. Then you had Bitwise's BIPB at $115.64 million. This suggests traders who are sensitive to volatility are, reducing exposure.
But the strategic bid held up. It remained.
It did, yeah. BlackRock's iShares Bitcoin Trust, IBIT, was actually the sole major ETF to record a net inflow. It attracted a pretty robust $60.36 million on that same day.
Wow.
And that capital flowing into IBIT, well, likely represents large strategic allocators, think pension funds, maybe endowments, practicing a very distinct buy-the-dip strategy.
That's a huge insight. So the tactical short-term money definitely added to the pressure, but this large conviction-based capital stepped in, providing that underlying floor. This suggests the market is structurally maturing, doesn't it, with these two very different risk appetites coexisting?
It seems that way, yeah.
Now, how does that push and pull actually translate onto the charts, especially after the price retraced from Monday's close around $115,273 down to, $110,432?
Well, since the price failed to reclaim those previous highs, the daily chart suggests the potential formation of a triple top pattern, which is, a classic bearish reversal signal.
Okay.
And we also see that caution kind of corroborated by a bearish divergence on the relative strength index, the RSI, which basically confirms that buying momentum was already fading before that sharp drop.
That sets up a pretty high-stakes defensive line then. The market looks consolidated, yeah, but where are the precise technical coordinates defining this battleground right now?
Okay, the critical defense line, the one everyone's watching, is the immediate flash crash low around $107,000. This level is absolutely paramount for the bullish argument. Really critical, because it converges with two major long-term technical features. You've got the upward sloping 200-day moving average and a long-term trend line that actually dates back to December 2024. So if the market holds $107,000, the bulls still have a case for, let's call it a necessary reset.
And what's the overhead resistance, the level that needs to be reclaimed to completely invalidate this recent bearish pattern?
That would be the $123,000 zone.
Yeah.
That corresponds to the prior highs we saw back in July, August, and September. Now, if the bulls succeed, if they break and hold above $123,000, we could potentially project a target up near $139,000.
Okay.
However, if that $107,000 support fails, well, a breakdown opens the path toward the next structural support area, which looks to be around $93,000.
Okay, $93,000. We've covered the technical fight, but the volatility driving it, as you said, comes down to geopolitics. Our sources suggest this risk isn't just, headline noise anymore. It's now an entrenched feature of the global economy. What specific actions are framing the U.S. China economic conflict this way in, the last 24 hours?
The dynamic has undeniably shifted. It's moved from, say, trade rhetoric to direct targeted economic action. China imposed sanctions on 5 U.S.-based subsidiaries of the South Korean shipbuilder Hanwha Ocean.
Okay, targeting subsidiaries.
Yeah, and simultaneously, new tit-for-tat port fees that both nations announced officially took effect. These specifically target maritime shipping infrastructure.
Targeting maritime logistics? And a South Korean supplier dealing with the U.S. That sounds like they're really striking specific supply choke points, doesn't it?
That's exactly why analysts are sort of moving away from calling this a trade war. They're starting to use the term a supply chain siege.
Siege. Wow.
Yeah. The focus is clearly moved to pressuring critical choke points, maritime shipping, rare earth minerals, semiconductors, using these targeted actions that are actually extremely difficult to reverse quickly.
And the implication for risk assets, Bitcoin included, is profound then. This isn't some temporary shock that just reverses next quarter.
Correct. These actions, they establish a new, persistent baseline of conflict. And this reality is likely going to exert continuous systemic selling pressure and definitely increase volatility on all global risk assets. Because the uncertainty for international business is now just, well, it's a permanent feature of the operating environment.
Okay, let's shift back then to the market response to that initial shakeup we mentioned, the huge liquidation event last week. Headlines screamed panic, but you raised an important question about market maturity. How controlled was that deleveraging, really?
This is where we get a really clear measure of market sophistication, I think. There's a compelling counter-narrative suggesting the event was, in fact, more of a controlled deleveraging. Because while headlines focused on the forced liquidations, the data tells a slightly different story about the reduction in open interest, or OI.
Right. So what percentage of that leverage flush was actually voluntary closing of positions?
Get this, only about $1 billion of the total OI reduction was actually due to forced liquidations of long positions.
Only $1 billion out of how much total?
The total reduction was much larger, meaning roughly 93% of the OI reduction came from voluntary position closures.
93%. Wow.
Yeah. So this means professional traders saw the macro and geopolitical news coming and proactively de-risked their portfolios. They didn't just wait to get wiped out by margin calls. And that capacity, that ability to absorb a significant leverage, flush, and stabilize relatively swiftly, that's probably the strongest signal of market maturity we've seen in years.
That is a huge positive for the long-term health of the market. Yet, short-term sentiment still seems extremely cautious, right? Judging by derivative indicators anyway.
Yeah.
What are traders watching now?
Yeah, despite that maturity we just talked about, current sentiment remains clearly bearish. No doubt about it. The Bitcoin perpetual futures funding rate on Binance, still negative. And this is a classic indicator that the prevailing view is short. Basically, traders holding short positions are paying a premium to keep those contracts open. And furthermore, we're hearing reports that professional market makers are pulling liquidity from order books, which signals caution and a heightened perception of counterparty risk among the pros. They seem to be waiting for better clarity on the macro path.
So short-term caution persists, even as global adoption seems to be chugging along, almost irrespective of the daily price action. What are the major long-term validation signals we're seeing from governments and regulators?
Well, there are two really major adoption stories right now that show that digital asset ecosystem is achieving significant milestones. And they seem, pretty decoupled from Bitcoin's short-term volatility. First, we have this really quite astonishing sovereign use case, the Kingdom of Bhutan. They're migrating their entire national digital identity system, which covers roughly 800,000 citizens, onto public Ethereum blockchain.
Wow, migrating a whole national ID system to a public network like Ethereum, that is a massive shift. It validates utility far beyond just finance or speculation, doesn't it?
It's historic, truly. It makes them the very first nation to anchor a population-scale identity framework on a public network. And the full migration is expected by early 2026. The second story is about regulatory normalization, this time in a key G20 market, South Korea. Authorities there have resumed their review of Binance's acquisition of the local exchange GoPax.
Okay, and what would an approval there mean for the broader market picture?
Well, an approval, which could potentially come by the end of 2025, would allow Binance to re-enter a really significant G20 market. And it signals a kind of global regulatory confidence, especially after Binance's previous rather large settlement with U.S. authorities. So these events really show that integration is proceeding, regardless of whether Bitcoin is trading at $110,000 or $120,000 this week.
Okay, before we wrap up, we should probably look at the corporate players too. The whole Bitcoin on the balance sheet thesis seems to be facing a bit of a stress test, doesn't it? Specifically around Japan's Metaplanet.
It absolutely is. Metaplanet, which, explicitly modeled its strategy on MicroStrategy, has seen its enterprise value dip below the market value of its Bitcoin holdings for the first time.
For the first time, that's significant.
It's a critical development, yeah, because it indicates the market is now applying a kind of valuation discount. It's scrutinizing company-specific things like operational risks or debt levels rather than just treating the stock as a perfect Bitcoin proxy. Investors are actively differentiating now.
So if investors are differentiating and maybe not granting that automatic premium anymore, does this shift pose a potential risk to the valuation of other corporate holders? Or is this maybe specific to Metaplanet's own operations?
It certainly introduces a new layer of scrutiny for the entire corporate cohort, I'd say. Moving forward, the market will likely reward firms that can demonstrate strong operational cash flow and, prudent debt management, even while holding Bitcoin, rather than those that are perceived as merely Bitcoin holding vehicles. And this scrutiny seems to be driving some corporate pivots, too. For instance, the public mining company Bitfarms just announced a strategic pivot. They're rebranding to focus on high-performance computing, HPC, and AI infrastructure projects.
Interesting. Leveraging their energy expertise.
Exactly. Diversifying revenue streams beyond just mining.
Okay, so if we try and connect all these threads back to the bigger picture, the market successfully cleared out that excess leverage last week, which is good. But now it's battling this fundamental, entrenched reality of macro risk, mainly stemming from that U.S. China supply chain siege.
That's a good summary, yeah. The immediate technical fight, it's between that critical support line down at $107,000 and the overhead resistance up at $123,000. That zone is really the battleground for short-term traders right now. The next few weeks will likely define whether this is shaping up to be a deeper correction or perhaps just a necessary reset before the next phase of accumulation.
So to navigate this highly complex environment, you should probably monitor three key signals closely. First, that $107,000 technical defense on any retest. That's the critical line, protecting against a move down towards $93,000. Second, keep watching the continued net flow data from the ETFs. Specifically, is BlackRock's IBIT still attracting inflows during these periods of price weakness? That confirms strategic capital is still buying the dip.
Right.
And third, obviously, any further escalation or, conversely, maybe a signal of de-escalation in that U.S. China supply chain siege narrative.
Definitely. And maybe here's a final provocative thought for you to consider. The market showed, I think we agree, immense maturity by voluntarily de-risking last week. It absorbed that leverage flush pretty professionally, yet current professional sentiment remains stubbornly bearish, right? As we see from those persistent negative funding rates. So does this reluctance to fully deploy capital suggest that professional traders are maybe discounting the geopolitical impact? Or perhaps are they still just waiting for more clarity, maybe from the Federal Reserve, before they're willing to make their next major move? Something to keep in mind as you watch the market's trajectory.